we're seeing a local higher in open interest and a push to silver beyond 30 here. But my point is here that silver open interest is not very much correlated to the silver price. I wouldn't worry that much in terms of long-term trends about silver open interest being high here. No, it probably does need to set down a little bit. I'm going to be following gold open interest, and silver should follow that as it naturally does. The trend line in the gold market has accelerated since the 2015 bottom, and we keep going higher faster. It might not feel like it during little pullbacks like this one, but that is the situation.
Rafi Farber, an investor and author advocating the Austrian Business Cycle theory, advises maintaining sanity amidst short-term fluctuations in gold and silver prices. Considering his recent analysis, Rafi Farber states that Chinese silver premiums have consistently reached about 13%. He notes 3 previous times this happened: in 2011 after silver peaked, at the end of 2014, and during the 2020 sell-off when silver fell to around $11.50. Silver prices quoted in Shanghai continue to break records, while premiums between the Chinese and London markets are also historically high. Silver's continued rise would be a generational event, as it would finally mean that the metal is emerging from its downtrend in real terms. Despite past high premiums occurring at silver price lows, Farber believes the current situation is unique because premiums are rising with increasing silver prices, showing sustained demand. He attributes this to a weak Chinese real estate market, prompting investors to turn to gold and silver for security. As per Farber, significant activity occurred again in 2011 when silver hit $50. From 2011 to 2020, open interest and silver prices were inversely correlated, but this isn't the case now. Farber suggests not worrying about high open interest in the long term, though it might need to decrease slightly. Meanwhile, Farber predicts that the trends in the gold market will significantly influence silver. He notes the rising trend lines in gold prices since 2015, with higher trend lines in 2018, 2020, and early 2024, showing faster acceleration. The price predictions for gold are generally positive, with many expert statements mentioning prices of $3,000 in the near to mid-term. Now, we present the clips of Rafi Farber's insights from his recent video. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I rectangled the 3 previous times when Chinese premiums for silver were at these levels, these consistently high levels of about 13%. So there were 3 times, right? Once in 2011 following the silver top, and that here, if you follow the rectangle, is at this low after the second major sell-off after the $50 top. So meaning this premium came at a local silver low. This premium also came at a local silver low at the end of 2014. And so did this one at the 2020 sell-off when silver hit about $11.50 during the COVID lockdown panic. This is different though, because these premiums are rising even as the silver price continues to rise. So this has never happened before. And it means that there is sustained demand in China. It doesn't mean there's not going to be pullbacks. We just saw one a few days ago. But the Chinese are stacking silver. Exactly why? I suspect it has to do with their falling real estate market, and Chinese need places to put money that isn't in real estate, and they're going back to their tradition of stacking gold and silver, because even in China, it was money and still is. A long-term look at silver open interest. So we have here, we see different stages in this market. In the 1970s, it was very obviously clear that the silver derivatives market, that the silver futures market was being used to manipulate the silver price down. You can see here that open interest climbed to all-time record highs that haven't even been close to being replicated since then. You have here in the 1970s, this is after the 1974 parabolic top here at about 650, I think it was. And then silver didn't do anything until 1979 for 4 years. So why didn't it do anything for 4 years? Because, well, everything was being done in the futures market, and that was clearly being done to suppress the silver price, stacking huge amounts of paper silver over the available silver supply. And that ended in 1979, 1980 as these positions were being closed, and silver went into a parabolic top that has still not been replicated since. This is the end of manipulation, right? At least as per the futures market affecting the silver price. And we see here that since then, in 2011, when silver hit $50 again, there wasn't much activity in the paper futures market. There wasn't much activity in open interest here. It wasn't being done there. I think this was mostly an ETF driven rally. It was an SLV mostly, and it could be that retail traders were just chasing it. But we see here that we have an inverse correlation as open interest gets higher. From 2011 until 2020, the silver price trended lower. So that was sort of like this, but not as much. And now we're seeing a local high here in open interest and a push to silver beyond 30 here. But my point is here that silver open interest is not very much correlated to the silver price. I wouldn't worry that much in terms of long-term trends about silver open interest being high here. No, it probably does need to set down a little bit. I'm going to be following gold open interest, and silver should follow that as it naturally does. The final chart I wanted to show you here is the trending higher in the slope of the trend lines in the gold market since the 2015 bottom. So if you draw a trend line from the 2015 bottom over here, late 2015 at around 1054, and then we had a trend line hit in 2018 at about 1250 something. We're way beyond that trend line now if you extend it out to the present. Then we established a new one at that bottom, which was tagged in 2020, late 2022 at 1610. Right, so that trend line, we're now at a new one with an even higher slope from the 1610 bottom until the October 2023, September, October 2023 bottom. That's also happened to be when silver hit $16. So that was about 1810, 1820, if I remember correctly, in gold. And now we have a new trend line established from then, which was hit in early 2024. And now we are way beyond that trend line. And notice also that these trend lines keep getting shorter and shorter by the time the trend line slope increases. So the rate of acceleration in the gold price has accelerated. That's what acceleration is. The trend line in the gold market has accelerated since the 2015 bottom, and we keep going higher, faster. It might not feel like it during little pullbacks like this one, but that is the situation.
During the interview, Rafi Farber discussed recent CPI inflation news, noting we've been at highs unseen since 1991 in sticky price inflation. He shows a correlation between gold prices and open interest, where a drop of 100,000 contracts could signal a strong momentum in the previous market. Gold futures are trading in a narrow band as markets adopt a wait-and-see approach ahead of Wednesday's rare joint offering of both U.S. inflation data and a Federal Reserve policy decision. Recently, open interest in gold futures saw its sharpest weekly decline since November 2022. Large speculators and managed funds reduced both their long and short positions, resulting in a slight increase in net long exposure, primarily due to closing shorts faster than opening longs. While futures traders remain bullish and gold is near its record high, the volume drop suggests some caution about expecting a new high soon. While shifting his focus to the next aspect, Farber points out the repo market's growing use of bank reserves, currently at 57% and rising since 2022. He warns that nearing the 85% mark, as seen before the 2019 crisis, could prompt another liquidity crisis and substantial Fed intervention. Let's get back to the interview.
There was some big news this week about the CPI, the Consumer Price Index inflation rate, which is pretty fluffy and not very reliable, but it does say something. We should keep in mind that according to this Atlanta Fed sticky price inflation CPI, which calculates prices that do not change very often, we are still at highs from 1991, 33 years. So it's a 33-year high in sticky price inflation, 4.3%. Yes, we have descended from all-time, not all-time highs, but since 1978, I think, or something like that. So yeah, we've descended here, but we're still at highs not seen in a third of a century. So put things in perspective. And now to gold open interest resetting here. I want to show you one of my patented rectangular charts showing correlations in gold futures between open interest and the price. So in this box, we see here that the gold price has descended from about 2450, from a high of 2450 to 2300. You'd say $150. from 2450. So that's about 5-6%, something like that. Not much of a move in gold for a move of 100,000 contracts down in open interest. We are at 436,000, 437,000, maybe a little bit lower today as you watch this. Gold did fall a little bit yesterday, which probably means open interest fell further. I would like to see us get back down to 400,000, which cemented a pretty strong bottom back in late February, from which we decided to rocket from about 2,000 to 2450. We could see that again if we descend to 400,000 open interest contracts here, and we're pretty close. So just to show you what happened last time, we fell about 100,000 contracts. We fell here from 500,000 at the beginning of 2024 as the year turned to the end of February. So that took about 2 months. That's it. Fall of 100,000 contracts, and it was only a fall of $100, 4.7%. So after that, we saw a big move, and we're seeing something similar, about $150. It's around the same percentage, and the same 100,000 contract fall. If we can get down to 400,000, that would be about 140,000 contract fall. And then we should be around a pretty firm bottom. This shows the amount of bank reserves being taken up by repos. Bank reserves is the high-powered money that is at the bank account of the banks at the Fed. And there's a total of about $3.4 trillion available now. We can see here why the repocalypse happened. Going into the repocalypse of 2019, the repo markets were getting more and more flooded, more and more crowded, as more and more hedge funds were accessing the repo market to fund their treasury shorts, which is the same thing that's happening now. There's record amounts of short positions in 5-year treasury notes specifically. I don't know why that security, but I do know that the spread between futures and spot in the 5-year treasury notes, futures, and the bonds is about 76 cents. Last time I checked, and so that's free money that you can get by selling futures short and buying the bonds themselves. So that's why there's so much short positions in 5-year futures, and those futures positions are being funded by the repo markets. So the same thing's happening now as happened back then. We're not at the extremes because we have higher levels of reserves, but the point is here at the high here, which caused the repocalypse, 85% of bank reserves were being taken up by the repo market. We're now at 57%. We've been trending higher since 2022. And when we get near 85%, that should be the next repocalypse, where the Fed has to print repos, print money to fund the repo markets, and then print a whole bunch of money besides. The higher we go, the closer we get to that wall, is the general point.
After an explosive 5-month run that saw precious metals across the board hit new multi-year and record highs, prices have pulled back this month as traders bank windfall profits, ready to capitalize on the market's next big move. How will global economic uncertainties impact your investment decisions in precious metals over the next year? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.